Hello everyone, welcome back to ACCA by Rida. So today we are starting officially the ACCA F3 Financial Accounting course. So we are today focusing on Chapter 1, Introduction to Financial Reporting. So this course is basically designed for students who are new to commerce and also the students who are from India, Pakistan, they are in grade 11, 12, or even BCom, and it's also a good refresher for those already familiar with the basics. So, my aim is to make these topics easy to understand using English throughout, which will help you get comfortable with ACCA terminology as it's a UK based qualification. So, I have divided this chapter into two parts, right? And we'll be covering part 1 of the chapter 1 in this video. As I explained, I encouraged you to read each chapter thoroughly and attempt the test your understanding and MCQs which are provided at the end of the book. This hand-on approach will deepen your understanding and help you remember these concepts better. So let's start by going over what you'll learn in chapter 1. So in this chapter we will know about the financial reporting, then we can identify and know about the types of different types of business entity, and we can identify users of the financial statements and the information they need. Then we can identify the purpose of the main financial statements, right? Then the elements of financial statement and accounting concepts and characteristics. So these are the things that we are going to learn in this chapter, right? So let's go further. So here, as you can see, the overview of accounting, in which there is a accounting consists of two elements. Financial reporting involves recording and summarizing, right, the financial activities of a business to reflect its performance and position over a period. This information is essential for the stakeholders like investors, lenders, right, customers, government agencies, and many more who rely on it to make significant economic decisions, even the employees as well. Therefore, providing quality financial information is vital. It is important for these stakeholders to make informed decisions. So, in this chapter, we'll explore the types of businesses, their stakeholders, and how financial reporting meets their information needs, right? So, this foundation is essential for everyone who is new to commerce and as well as new to ACCA platform. So as it forms the basis for future ACCA studies, particularly in financial reporting and strategic business reporting. So as you know that I have already discussed the two types of accounting, financial accounting and management accounting in my previous videos, but this chapter includes both of these. We need to understand both of these more, financial accounting more than management accounting. So let's understand financial accounting first. It focuses on creating financial statements for external users. Who are the external users? External users are like employees, lenders. Lenders are those that give us money to invest in our business, like bank. Then we have customers. Then we have public, right? Then we have government institutions and many more. We will discuss it later. So these are the external users. Then financial accounting, from these statements help investors assess companies for potential investments, and the preparation of financial statements follows accepted standards such as IAS, International Accounting Standards, and IFRS, International Financial Reporting Standards, which aim to reduce global differences in accounting practices. So let's move on to the management accounting. So it is tailored for internal business use, helping management in planning, strategy, and decision making, right? It's already mentioned here. So it provides detailed information such as cost, profitability, and resource optimization for better control over business operations. Now we have users of financial statements and who uses financial statements. So financial statements are essential tools, right? Financial statements are essential tools that used by you know, a variety of stakeholders to make informed decision. And here's a breakdown of key users and how they rely on financial information. So let's understand each of them one by one. So let's talk about first investors. Investors want to know if a business is profitable and has the potential to grow. For example, if someone wants to invest in a retail chain, they'll look at its income statement to assess its revenue growth and profitability over time. Correct? Then we have lenders, which we also say like creditors. So banks and financial institutions check financial statements before offering loans. For instance, a bank might review a company's balance sheet to ensure the company has enough assets to secure a loan. Correct? Then we have management. So managers use financial data to make strategic decisions such as budgeting and resource allocation. For example, if a company's profits are declining, managers might use financial reporting to identify cost saving opportunities. Government and regulatory agencies, tax authorities use financial statements to determine the taxes owed by a business. For example, revenue data from an income statement helps tax authorities assess the taxable income. Then we have employees. So, employees may also be interested in a company's financial stability as it can impact job security and salary prospects. For instance, if a company reports high profitability, so employees might expect bonuses or raises. So, by understanding these different users, we can appreciate the purpose of financial statements and why they are so detailed and standardized. Let's move on towards the types of business entities. So there are several types of business entities and each with unique characteristics tailored to different business goals. So let's look at the three main types, which is sole trader, which we also know as sole proprietorship. So this is a business owned and operated by one individual, one person. And it's simple to set up and offers complete control to the owner. For instance, a freelancer or a small grocery store owner is usually a sole trader. Then we have partnership. So, in partnership, a business owned by two or more individuals who share profits, losses, and responsibilities. For example, two friends opening a law firm together would form a partnership where they had jointly managed the business and share the profits. Then we have limited liability companies. So these are the company corporation, and it's a separate legal entity owned by shareholders, correct? And offering limited liability protection. This means that owners' personal assets are not at risk for company debts as compared to sole proprietor and partnership. Large corporations like Google or Apple are examples where shareholders can invest in the company without being personally liable for its debts. Choosing the right entity depends on factors like liability, tax implications, and funding needs. Moving on to the operating as a sole trader, partnership, or company, the main points are that it is the most important consequences of this is that a sole trader has complete personal unlimited liability. Like if there is any losses, if a sole trader has borrow loan from a bank and his company went through a big loss, so the loan has to be paid by his personal assets, correct? And same is for the partnership, because in partnership, whether there are two or more partners, they have to pay the loans, they have to clear the debts by their personal loans. As it is not legally distinguished from its members, but personal assets of the partners may have to be used to pay debts of the partnership business. So their personal assets has to be used to pay the debts. And the advantage of trading as a partnership stem mainly from there being many owners rather than one. This means more resources may be available, including capital, specialist knowledge, skills, and ideas. Correct? And administrative expenses may be lower, and partners can substitute for each other. Now, let's break down the difference between these three business entities in more detail. So, first would be ownership and control. In a sole proprietorship, the owner has full control over business decisions, and partnerships involves shared decision making, because equally they have paid the investment amount for their business, correct? So they have equally decision making power, which can sometimes lead to dispute. But on the other hand, companies are controlled by a board of directors and shareholders, which can make decision making slower but often more structured. Then we have liability, like sole traders and partners generally have unlimited liability, meaning personal assets are at risk if the business fails. In contrast, shareholders in a company have limited liability, which means they only lost the amount they invested. So, sole traders and partnerships typically face personal income tax on business profits, whether on the other hand, companies pay corporate tax, which can be advantageous in certain situations. For instance, a sole trader which would pay income tax on all profits, while a corporation's profit would be taxed at the corporate rate, often with additional deductions. Then, sole traders and partnerships may have limited funding options, relying often relying on personal funds or bank loans. Companies, however, can raise capital by issuing shares to the public, which is why large corporations can expand more easily than sole proprietors or partnerships. So, while forming a company has its advantages, incorporation also comes with a few disadvantages. So, let's talk about complexity and cost. So, setting up a corporation is often complex and expensive. So, there are many legal requirements, and corporations must adhere to strict regulations. For example, filling files and annual reports can be costly and time consuming. Then we have double taxation. So, in some jurisdictions, companies face double taxation where profits are taxed at both the corporate level and again as dividends to shareholders. This does not happen with sole proprietorships or partnerships where profits are only taxed once. Then we have another disadvantage, that will less control for owners. So, in a corporation, original owners may lose some control over the business, especially if there are many shareholders. And this can be challenging if shareholders or board members have different visions for the business directions. So, to sum it up, incorporation may not be ideal for everyone, especially for small business owners looking for simplicity and control. Now let's talk about framework, which is developed by the IASB or International Accounting Standards Board. The IASB's framework provides a set of guidelines for preparing and presenting financial statements, and this framework helps ensure consistency, transparency, and reliability in financial reporting. So the IASB framework guides companies on how to present financial information to ensure that it meets the needs of the users, correct. So the main purpose of the framework is to provide a foundation for developing and reviewing accounting standards, ensuring they are consistent and useful. So, let's talk about the elements of financial statements in the framework. So, the framework defines key elements including assets, liabilities, equity, income, and expenses. And each of these plays a crucial role in giving a complete picture of a company's financial health. And so, think of this framework. So, think of this framework um, as a rule book that companies follow to ensure their financial statements are prepared accurately and consistently. Prudence, which is also important for your MCQs. So, prudence is an important concept in accounting that focuses on exercising caution when recording financial information. So, it is a principle that suggests companies should not overstate income or assets, nor understate expenses or liabilities. This approach helps ensure that the financial statements present a realistic picture of a company's financial health. Now, let's talk about the qualitative characteristics of financial information, which are the essential attributes that make financial information useful for decision making. And these characteristics are divided into two main categories: fundamental and enhancing. So, relevance. Financial information must be relevant, meaning it should help users make predictions or confirm past evaluations. For example, if a company is launching a new product, relevant information like projected sales can help investors to decide if they should invest or not. Then we have faithful representation. Financial information should accurately reflect the company's financial situation. And this means the information should be complete, free from error, and unbiased. If a company's report includes all revenue and expenses without manipulation, it's considered faithfully represented. Then we have another category which is enhancing characteristics. First is comparability. So users should be able to compare financial statements across different periods and companies. And this is why companies must use consistent accounting methods. So then we have verifiability. Financial information should be verifiable, that allow users to ensure it faithfully represents the reality. For example, if an auditor checks the accuracy of a company's account, so this adds verifiability to the financial information. Then we have timeliness. Information should be provided to users in time to make decisions. For instance, if financial statements are only available a year after they are relevant, so the users might find them less helpful. Then we have understandability. So, financial statements should be presented clearly and concisely so that users can understand the information, even if they are not experts. This is why company uses simple language, and standard formats. And these characteristics ensure that the financial information is meaningful, accurate, and accessible, making it easier for stakeholders to make informed decisions. Right? So the stakeholders are maybe they have money to invest, but they are not more knowledgeable than the board of directors. So they hire the managers to to run the business. So it would be very easy to for them to understand the financial statements as well, financial information. So this is the part 1 of this chapter. Thank you for watching. In today's lecture, we've covered some foundational concepts in financial accounting, which ensures that data in financial statements is useful and reliable. So if you found this lecture helpful, please like, share and subscribe ACCA by Rida. Don't forget to hit the bell icon so you don't miss any update or any future lectures. And leave any questions you have in the comments and I'll be happy to answer them. See you in the next video.